Hi, this is Denjola from 910 Finance, and welcome to our video for purchasing investment property by SMSF. What is self-managed super fund? How to purchase a property through self-managed super fund? Okay, this is a question I've been getting lots lately. So people want to know if you can do it, how you can do it, and what are the implications to purchase property through self-managed super fund. Okay, so let's get started. Okay, so firstly, let's start off with a disclaimer. We are not self managed super fund advisors or financial planners. Please obtain legal independent financial advice before considering setting up a self managed super fund. We don't know if it's right for you or not, but please take a professional advice on that. Okay, so what is SMSF as per the ATO website? Self managed super funds are another way of saving for your retirement. The difference between a self managed super fund and other types of funds is that generally the members of an SMSF are also the trustees. This means the members of the SMSF run it for their own benefit. When was it last modified? Okay. Just wanted to read this word by word so that it's very important and you get it clearly what it means. However, my interpretation of this is let's say as of today, most of you would probably be watching this video would have your funds invested in our industry fund. It could be like Rest Super, Sun Super, Australian Retirement Trust. So what happens is when you get paid by an employee or you pay yourself a certain amount of money from Super, it goes to an industry super fund and it's automatically invested in their generic portfolio as to whatever. And if you log in and you go, you should see all your history, all your payments from your employees. People have absolutely no idea where the money for super is, but please make sure you do get your logins, even if it's an industry super. It's not a bad, it's a big investment. So please make sure you keep track of where the money is, even with the industry super. So anyways, so the money is there in the industry super. So what happens with self-managed super fund is you can actually set it up as a trust and you can roll over the funds to the self-managed super fund and then you can invest the money as and how you like it. Okay, so yes, there is a little bit of complexity around it, and that is what we will be discussing in this video. Okay, so I will start off with the structure, with how a self-managed super fund structure normally looks like. Look, it does get a little complicated, but we're always here to help you when it's the right time. And for me, my accountant was an absolutely genius in helping me set this up. And look, you can take financial advice and help from your accountant in doing so as well. Okay, so the first thing is we need to set up a self-managed super fund, okay, and then a corporate trustee for the SMSs. So this is a trust structure. So for those who have never done a trust structure, please do get proper guidance. But that's the first part of it, setting up a self-managed super fund and the trust for the super. Okay, once that is set up, it's normally done by the accountant. All you need to do is go and then roll over your funds from your industry super to your cash management account. So the Macquarie Bank account, it could be any bank you'd like to open your cash management account with. So once this is all set up, you can get your industry funds to roll over to the bank account. Okay, now what happens is, let's say for discussion purpose, you've got $200,000 in a super between you and your wife, you combine and you make it one. Okay, look, up to you can have maximum up to six people in a super as of now, but normally it's a husband wife tag team. That's how it's normally done. People don't like to work with too many other people, so just husband and wife, just to keep it safe. So let's say you've got 200,000 and you wanted to invest $150,000 as a deposit to buy a property, and another 50,000 you can buy shares and manage funds. That's there in the video here. Okay, and I'll explain what's there in the dotted lines. But let's say you've got 50,000, you can have shares, you can have managed funds, and your contribution will keep adding to your cash management account. Okay, now the very important part is in those dotted lines in there. If you were to go and borrow money from the bank to buy a property, you would be using your deposit as money from this SMSF as a deposit. For example, if you have 150 left over from the previous example, we can use this as a deposit. And let's say you can get a loan from the bank for 400 and you can buy a property for 550, 600, you got to include stamp duties and stuff, so other expenses, so you can go and buy a property. But for that setup, you need to set up a property trust and a corporate trustee for the property trust as well. So that again is a new layer of complexity in there. Again, set up by the experts for us. The reason this one is done again as a separate entity is just in case your self-managed super fund, let's say you can't pay a loan through your self-managed super fund, the other um, part of the self-managed, your cash balance and your funds are not affected. It's called a limited recourse borrowing. So you only the loan from the bank or the house would be, as a liability. You won't have any liabilities on the other side of the thing. So limited recourse borrowing, that's the keyword. As we go through, you'll hear that a little bit longer. So very simple. You set up a self-managed super fund and the trustee for there. You open up a cash management account, and then you can do what you would like with your with the funds. You can invest in shares, manage funds, or you can use it as a deposit as a property. However, please be mindful, there are a lot of regulations around it. So there need to be an annual auditing, tax returns done for the SMSF, and there are a little bit of legalities around it. So there's a huge penalty for if you misuse the money from the self-managed super fund. So please be aware of that. Okay, now this is where we do come into play. So understanding the lending process and borrowing capacity. Okay, so how much can you get from your borrowing capacity? So I've just put it in bullet points. So these are the main points. So one of the biggest reason we would our clients are investing in self-managed super fund at the moment is it doesn't affect your borrowing capacity or your personal borrowing capacity, because this is set up as a separate trust. Everything, the whole property is treated as separately and nothing to do with your personal capacity. So people, those who've exhausted the personal capacity, investors, those who bought a few properties and they can't borrow anymore, most of them are going for this structure. The next one is the loan amount will depend upon these two things. So how much can we borrow from a self-managed super fund? Okay, very dependent on what's your current contribution from the employees and what is the rent you'll be generating from the property you buy. So those are the two main things the bank look at when giving you loans for the self-managed super fund. Okay, how much you can borrow. So that's the main thing. Look, self-managed super fund loans are not cheap. They are around 1.5% more expensive than the current investment rates you'd see in the market. So please be mindful of that. Again, we will do our due diligence when you go for a loan. We'll crunch some numbers and we'll take it from there. Okay. The other thing is most banks do expect you to have a certain buffer. So you can't use all the funds to go and buy a property. You need to have a 10 or 15, 20% buffer just as a liquidity test, because just in case there is any issues with, the repayments and stuff, they need to have some buffer around it. Happy to discuss this in the future as well. Self-managed super fund lending is mainly done by second-tier lenders, so you don't see the big banks like CBA. They used to do a lot before, but they've come out of the space. Too much of legalities around it, so you'd see a lot of smaller lenders like Bluestone, Granite, Liberty that does this type of loan, and it's not by the big lenders. And the loan is done through a limited recourse borrowing arrangement, which I showed you in the other on another slide, where we open up a property trust, and the self-managed super fund is set up separately and the property trust is set up separately, and then we buy through the property trust, so that if there is any issues or we're not able to make the repayments, we are just liable. Only the property itself would be liable and not our personal funds in the self-managed super fund. I hope, look, this is a very big overview. If there's a lot of things you're taking in, take it easy, but we will go through it as we do the loan. But as you understand these main points and the minute things, we'll cover it as we go. Okay. Okay, so let's go to the next slide. Why buy property through super? Okay, so look, why buy property? Everyone asks me the same question. As I said, I don't know much about shares and stocks. I am a big property fan. I do invest in property and I love properties. Okay, but why buy property through self-managed super fund? I think for the very simple reason, it's power of leverage. I've only written bullet points in here, but the first one I believe is the biggest one, but not necessary. You have to do it, but I probably believe in the power of leverage with property. So what it means is, let's say you've kept 100,000 in your super and you haven't done anything. Sorry, 200,000 in your super and you haven't done anything at all, and it's you're just waiting for it to grow normally. Okay, let's say in the next 10 years or next 15 years, the 200 would probably go and become $400,000. There's two reasons. One, it's growing at 6 to 7% annually, and the other thing is you are making your own contribution. So look, just hypothetical figures. So the 200,000 probably would be around $400,000 to $600,000. Whereas if you use that $200,000 or $150,000 and buy a property of $600,000, so loan and your deposit of $600,000, and you leave it for, let's say, 15 years, and the property doubles up from 600,000 to $1.2 million in 10 years, you see the power of leveraging. You are almost doubling the super what you have. Look, as I said, this is just a very basic video. We can discuss about it, but again, look, there might be times the property prices never increase in 10 years, so you got to buy right, and we can talk about that as time goes by. Okay, so I think in very simple, we are leveraging the bank's money to compound our gains. So that's it. Look, the other one is tax benefits. So whatever you have, the 15% tax on income. So whatever you make in a super, let's say you've got positively geared income, or whatever you've got rentals coming in from the super, you only have to pay tax on 15%. For example, most of you are on a 47% high rollers at the moment. If you're earning a certain limit, you're paying on 47%, so 15%. So that's a big tax thing. The other big one is, if you sell your property after a certain period of time, you only need to pay 10% on the capital gain taxes, or 0% if you're in the pension phase. So that pension phase might come a little later. Otherwise, it's just 10% of the capital gains tax. Right now, the capital gains tax is massive. You're again paying on the 47% tax bracket if you're there. So you would see all this difference. But for me, look, rather than tax benefits, for me, it's always the power of leverage. I did my numbers. I feel, look, if we buy right, and the property doubles, I think we are a winner all the way. But look, each one to their own. Please be mindful, take good financial advice before you make this leap. Okay, lastly, we'll just go through the frequently asked questions. I get this all the time. I'll try to cover as much as possible. If not, just give me a call and we'll take it from there. Okay, can I keep my industry super fund and insurance? So what happens is, when you have an industry super fund, let's say Rest Super, you have a certain type of insurance which is covering your personal think death insurance and permanent TPD insurance. So in my personal case, what I did was I completely shut down my industry super fund, and I took a separate insurance myself, and then the insurance fees and charges are coming out from my cash management account. Okay, but some people those don't want to do that. What you can also do is you can keep the existing industry fund active, and you can set up a self-managed super fund. You can keep both active. However, please be mindful that there are certain fees and charges for your existing super as well, so industry super. So see if that's feasible to keep both. If not, okay. Is it more expensive to buy a property through super? Look, it's not. The property price is the same. There is no extra cost for you to buy a property through super. But what is more expensive is the setting up of the super and the managing the super. So that is the key thing that is a little bit expensive, okay, but not the property itself. Maybe the interest rates on the loans are a little bit more expensive as well. We'll probably touch base when you're ready for that. So that's why you do try to put a bigger deposit from your super and have a smaller loan. Okay, can I build with an SMSF? So build by me build, I mean, can you build a house? Okay, yes, you can build a house with a self-managed super fund, but it cannot be from a bank loan. Only if you are using your cash outright. Let's say you've got 700,000 in self-managed fund and you want to build a home, you can do that. But if it's a loan from a bank, you can't build. Okay, just a very important thing with self-managed super fund, you're only purchasing investment properties, number one, and there are a lot of restrictions around what kind of properties you can buy. But again, that we can touch base when you're ready to jump into that investment phase. Okay, can I negative gear through my self-managed super fund? Absolutely, you can negative gear, but there won't be too much of gearing, because again, it's 15% tax bracket. This is where you might not be comfortable with the negative gearing part of it. Can I live in my SMSF property when I retire? Yes, you can, but the SMSF should not hold the property anymore. Once you transfer the property to your name, you can then go and retire in your place. Because I hear a lot of people saying, I want to buy closer to the beach at the moment, and once I retire, I'm going to move there. You can do that, but it needs to come out of self management, and you can transfer it. Again, your financial team can help you there. Okay, but I'll just come. Besides, I go before I go there, I'll just come to the next two questions. What is the minimum amount required to set up a self-managed super fund? Again, very interesting um, conversation here. Look, there's no right or wrong around it. My ballpark figure is 150 is probably a good start. 150,000 between you and your wife is a good starting point. But we can discuss. If there's any question, just give me a call and we can discuss where we go from there. It depends upon the type and the cost of property you buy as well. Okay, what are the costs involved? So this cost involved in setting up the self-managed super fund, just as a ballpark figure, just to set up the self-managed super fund, I think it's close to, that's how much charge my accountant charged me, close to around $1,200, just to self-managed super fund. And once you're up and running with the self-managed super fund, you're looking at around, and if you decide to buy a property through self-managed super fund, setting up the bear trust and the other dynamics around it, cost an extra $800,000. So around $3,500 all up to set it up, up and running. And these funds are normally funded from the super itself. Okay. And then once this is all set up, let's say you buy a property or you just keep it as it is. You don't want to really keep it as it is. You want to start investing and doing something with it. There is a cost for an annual tax and audit, so it needs to be taxed and audited, so that the accountant charges a fees for that. So once the setup is done, there will be an annual tax and audit fee. So this is what I can understand from my cost involvement. But please again do your due diligence around it. Okay. Um, Okay, and just for your information, if you are to set up a self-managed super fund for a property, please don't come and say I want to buy it today and try and come up with a property. It normally takes about a month to set it up properly. Have a chat with your finance team, your advisors, just to make sure you're setting it up correctly and doing the right thing. And then give them around a month to do all the rollover and get started. Okay, and one more. I'm keen to start the journey, but need some guidance, and that's where we are here from. This is an incredible amount of responsibility when it comes to managing your self-managed super fund, and we always recommend working with an experienced team around you. So that is where we come here, and we've done it ourselves. Always ready to help you live the journey and think. Look, we're never 100%. I always tell people we're never 100%, but we're always there for you if you need help. Okay. um, yep, and thank you for watching and hope this was useful. Look, if there was anything not clear, please give me a call. It won't even be clear in the first place if this is the first time you're thinking of investing through super, but we can always sit down, go through the points step by step, and I'm always here to help you if you need. Have a good day.